We have with us Tanvi Gupta Jain and R. Gandhi. Mr. Gandhi, I want to come to you first. There is no change this time. Do you think Reserve Bank of India wants to just assess the situation and after that only there will be next course of action which will be taken by Reserve Bank?
Thank you. It's not so because the Reserve Bank has taken due note of the position that in the fourth quarter of this fiscal and the first quarter of the next fiscal, the inflation is going to be 4+. Because that is a very important assessment as of now. When such increasing inflation is expected, and then and added to that the immediate problem of tariff-related, how it is going to be impacting the economy, that is to be watched. So that's why they are quite cautious that even though growth needs to be supported, credit growth is not yet fully and the robust term that we would be expecting, but still they wanted to be cautious because inflation will be trudging up in the fourth quarter and the first quarter of next fiscal. That's why the cautionary note. That's why the pause as of now. That's the right way because that is what the neutral stance indicates. That the neutral stand indicates that the MPC's readiness to move either way based on the incoming data. That's why I'm not surprised at all that they wanted to pause at this point in time.
Let's also welcome Radhika Rao and Ashima Goyal to the panel. Radhika, we were discussing about the expectations earlier, but now Reserve Bank of India has stuck to the fact that they want to see the impact. But one important point was mentioned about Q4, whereby the inflation is expected to edge up and more so in Q1 of the next financial year. What is your take on that?
Yeah, hi. Certainly, I think heading into this meeting, we had expected two things: that the tone might be a bit more dovish, and that there could be some room to cut rates. But the guidance was really quite balanced in the sense there were no specific cues to mention that the central bank has left room to cut rates. So we'll be taking note of that into our own assumptions. And just like we were expecting, inflation projection was cut quite sharply by almost 60 basis points to 3.1%. And I think their observation is absolutely along what we were expecting as well, which is that, if you see what was the trend between 2016 and 2019, whenever inflation drops to these levels, 2% or below that, thereafter, in the next 12 months, you tend to see a very sharp increase. And that's exactly what the governor also highlighted. And that's what we were expecting as well, which is for the headline CPI to edge back towards 4%. So if you see the revised trajectory that they have, inflation quarterly numbers, it does show it going back to 4% plus. We had just expected them to front load some easing, but after the tone today, it does look like it will take, the bar has been set higher. And they're not necessarily seeing any growth risks at this point, either from domestic or from global catalysts, and hence this very, I would say, neutral guidance in terms of further rate movements from here.
Ashima, hi, I want to come to you regarding the tone which has been there in the current policy. As you have been there in MPC before, I want to understand from you, what is Reserve Bank of India thinking in terms of taking action to pedal growth now?
I think they're looking at expected rise in inflation ahead, and therefore that the expected real rate will be around unity, even at 5.5, and that this should be adequate to sustain growth, along with the continuation of pass-through of past rate cuts. But my own view is that earlier they had also remarked that inflation is getting anchored at 4%. And core inflation is going to stay around 4%, the governor said in his speech. And over the last more than 12 months, it's been below 3.5, around 3.5. So most research now is showing that headline inflation comes towards core, approaches core in the longer term, which is the most stable trend. So if you look beyond just base effects, then I would expect inflation next year to anchor around 4%, yeah, which is the monetary target. In that case, there was room for cutting now, but they have given a very conservative inflation forecast, which suggests that it is better not to cut.
Yes, definitely. But more importantly, I did not also see any announcement of any divided house or a unanimous decision was taken, especially on uh, getting up on the pause mode this time. But talking about inflation, that is going to go beyond the target of 4%. And more importantly, Governor also mentioned about core inflation being above 4%. What is your take on that?
That is what I'm saying. He said core inflation would stay around 4, but much of that is due to a gold price increase, no? And the base effect of that will wear off. Then the main core inflation categories, as I said, have been around 3.5% for more than a year. So core inflation and other commodity prices have been softening. Firms are finding competition and not able to pass through price increases. Their margins are, they're willing to even take a cut in margin. So I don't think broadly core inflation is going to rise above 4% next year. Yeah. And research, food inflation is volatile. It might rise, but it tends to approach the stable trend inflation in the long term. Even research shows that. So overall, I expect inflation next year, barring some unforeseen global tensions or supply side shocks, to anchor at the target of 4. Yes? So if inflation next year is at 4%, because core inflation, even the governor is saying, is going to be around 4. Yeah? And actually, as the gold price in base effect wears out, it might fall below 4. So that will absorb any food base effects. And overall, I think the success of inflation targeting is that expectations are getting anchored around 4 in firms' price setting and so on. So in that case, there is room for more repo cut today, because at 3.1 inflation and 5.5, the real rate today is still above 2%. And historically, we have seen that whenever the real rate is above 2%, this means the last 15 years, growth slows. And there are many signals of growth slowing currently. So I think a rate cut today would have given more confidence to the economy that monetary policy is sustaining growth.
All right, let's also go to Tanvi next. Tanvi, hi. I want to understand from you the tone which has been set by Reserve Bank of India. As Ashima was also discussing, the real rate of over 2%. If there was an action which is anticipated by Reserve Bank of India, why not now? Do you think the data has given more room, and more importantly, the Trump tariff impact is yet to be seen?
Absolutely. So I agree with you that the data has given us more room. RBI has revised the inflation target 3.1, very close to where we are estimating our full year inflation at 3%. If I look at real policy rate, what RBI has been highlighting, somewhere in the range of 1.4 to 1.9%, which basically means a terminal repo rate could be brought lower, somewhere around 5 to 5.25. But I would say why not wait, because the tariff situation, especially with US trade tariff, is still unfolding, whether the tariff is going to be 25% with an unspecified penalty or it is going to be revised. At this point, it is not known. The growth downside risk will emerge depending upon the quantum of tariff and where India is relative to the trading partners. So I think we have bought some more time to look at the evolving tariff situation, because I don't see from an RBI perspective inflation to be a problem. Inflation is definitely going to be contained. So the next rate cut, if at all, opens up only in the October policy, and by the time we would have known what is the outcome of India and US trade discussions and what it means from an overall growth perspective, not only from the next 3 months, but also what will be the larger repercussions on India, even from a next year perspective.
Was an announcement this time which is made regarding internal working group on liquidity management framework. Although Governor did mention that WCAR is the rate which they may stick to, but what do you think will be the next course of action which is persisting, and especially on liquidity management framework? We have seen throughout the year there has been a lot of debate how to manage that, although currently we are in surplus liquidity currently. But do you think any of the changes are going to be there after these recommendations?
Obviously, because periodically the Reserve Bank looks at its liquidity framework, the operational framework. For that purpose, this committee has been formed, I assume. And naturally, because when there are little elbow room in terms of policy actions, there then the bank has further tools in terms of liquidity management to reach its objectives, either through, though indirectly, whether it is the interest rate, inflation management or growth supporting activity. So through liquidity management also it can do. So that is why, and liquidity management also factors in normally the operations or the developments in the external sector. So it is a complicated one. Many times it can be kind of tactically against normal inflation and growth dynamics. It can happen. So that's why this has a lot of finesse is needed in terms of liquidity management. To look at new liquidity tools and other kind of things also will be debated. So that's why it is good that they want to have a relook at the current framework. We cannot predict what kind of suggestions is likely to emerge from them, but we can say that by more frequent way of managing liquidity, because now with the digital payments getting highly more important, not just at the small value payments, even high value payments, that would mean that the action, liquidity management action by the Reserve Bank will also be have to be nimble, number one. Number two, it also will now, it is 24/7 large value payments are being affected. That would also mean that correspondingly, the liquidity situation could change vastly between morning or afternoon or evening or post-evening matters. So that is why the new look, keeping all these realities, new way of managing liquidity is definitely warranted.
All right. Also, let's go across to Jayesh. Jayesh, hi. It is a no change kind of a policy. When the expectation was, some economists was there at least, that there will be a rate cut. So there is no rate cut this time. Last time there was an expectation of 25 basis point, but rate cut was 50 basis point. How do you think bond market will react to that, considering what we have seen?
So I think bond markets given up hope even on last time, I think from 2013-14, even though governor tried to explain this time also that when they mean neutral does not mean that they cannot cut, but it could be either side. But somehow bond market took that last policy. And in this policy, looking at the Q1 27 number, everybody is shaken, including myself. I would have expected a rate cut, as Shashimaji also said, on the food inflation, which is very, very benign after almost 77 months. So we saw such a nice food inflation, lower inflation. In fact, if you look at it, FY26, it definitely deserves a rate cut. But what really shocked right now is the forecast for FY27, which is the first quarter at 4.9. I have no view on that. But if that is a forecast, naturally everybody is shaken. Of course, I had a slightly different view as compared to others. You see, global uncertainty is one part. Geopolitical risk has kindly softened, as Governor also said. Of course, you have this tariff uncertainty, but if you look at it, uncertainty of tariff, right, in whatever the case may be, the action of that should be more a softer rate and supporting growth. So from that perspective, there was some expectation, or from my side also, that we would see some rate cut. But looking at the Q1 27 at 4.9. We need to understand how they came at 4.9. But yeah, that's a very shocking number.
Let's also welcome Trideep Bhattacharya to the panel. Trideep, hi. The market has not taken well the status quo by the policy. Do you think there was an anticipation of a rate cut?
Yes, as equity markets, we always welcome animal spirits. And given that rate cuts did not materialize to that extent, there is a bit of a disappointment. But I think I would say that, look, I would call it a balanced pause rather than anything severely disappointing. The reason I say so is, we've seen a meaningful amount of rate cut already. Has not happened so far from when I speak to companies and the economists, is that the transmission of that to the real world, which is basically lending in the form of improving credit growth, etc., has not really happened. So I think first that needs to flow through for the RBI to take a further stance from where we are. Even though inflation has cooled off, the rate transmission is very key for growth rates to start improving in the back half of this year, which all of our expectations are and the eyes are on that. On top of that, there is an added angle, if I may call it that way, of prolonged tariff-related uncertainty. What we thought would get resolved in a month's time is taking longer than that. So having a bit of firepower intact for later on, in case needed, is not a bad way to sort of approach from a policy standpoint. The third angle that I would say is that in the context of tariff-related uncertainty, whether we go a fiscal route to kind of boost the economy or kind of give further monetary easing is another question which I think I'm sure the North Bloc would be thinking about in a centralized manner. So I think given all those puts and takes in place, I am not unduly surprised with the stance that they have seen. I think the RBI probably wants to see the transmission a little bit coming through before they take further action. But the jury is out on that one. I don't think the growth problem that currently we are witnessing in the form of an economic slowdown is solved yet. I think it will take a few more measured steps going forward for that to happen.
Mr. Kumar, also there was an announcement of a new liquidity framework which is currently underway. There will be a consultation paper which will be released based on the internal working group. Where do you think gaps are there as far as liquidity framework is concerned?
No, I think we have to wait for the report of the internal working group. And once the report is out, then I think it would be fair to make a comment on that. But from bank's perspective, we know that through CRR, a lot of preemption of resources happened. But last time, of course, as part of the monetary policy, RBI did give some relief to the banks, and that's where we are seeing its impact, and there is enough liquidity in the system as of now. So we are in a regime where there is ample liquidity in the system, and the rates are showing a downward trend. And from the peak, the rates have come down by 100 basis points. In every monetary policy, we cannot expect that RBI will keep on cutting the rates further.
The impact of CRR cut is yet to be seen. So, I want to understand, do you think that there is a scope for further credit growth in the market on the back of the decisions which has been taken by Reserve Bank of India? And more importantly, when you're talking about rate transmission, do you think many of the banks which have reported weak macros, I mean, at least in the commentary they have stated, so there is also rising stress. Do you think that is also weighing upon the rate transmission?
No, I've already explained to you how and what are the constraints on the banking system. And there is a rigidity on the both sides, the loan book side as well as the deposit side. As far as CRR is concerned, what it does is that because of the preemption of resources, the cost for the bank, when there is a CRR cut, it comes down. To that extent, there is an impact, even if it is marginal, on the income of the banks. So it becomes a combination of factors. So today's scenario, if I look at the credit growth, it's all it is a demand supply function. But today, looking at the state of affairs, I don't think there is any supply side constraint when it comes to the growth. And if there are projects, if there is a demand from the corporates, then I think credit growth can pick up. The retail side, I think the banks have been doing well. There were certain pointers from Reserve Bank of India about their discomfort on the growth of unsecured personal. And we have seen that there is a slowdown and there is also some stress building up there. So the growth in the retail segment, particularly in the P, what we call the P segment, there is a slowdown. The overall structure of the lending, there has been a key shift, which can be seen in the balance sheet of all the banks. And again, I will take the State Bank's example that at one point of time, the corporate book of SBI used to be in the range of 60% and retail, agriculture and MSC would be 40%. And now this ratio is almost reversed, where corporate book, it has gone down to 40%. So now which sector there will be demand? But if you ask me, the bank's capacity to lend, it is very much there. There is enough liquidity. And the growth will be now a function of like the demand and not as much from the supply side.
All right, Ashima, I want to come to you regarding your understanding of this time the tone of the governor. He has highlighted about the economy. He has mentioned mixed kind of signals, but which are the pain points you think and due to which the decision of a pause was taken just to wait and watch?
I think he has given a balanced commentary. He sees good pass-through. And possibly the external pressures and tensions that are persisting has induced them also to wait and watch for some time. As I said, 25 BPS is not a very large amount. And therefore, if they cut now or cut later, it should not make, in another 2 months, it should not make such a difference. But the issue is, I think the last MPC established that we are able to, in India, take a policy decision independent of global pressures. We have the room to do what is best for our economy. That is why I think a rate cut today would have given a signal that policy is countering global pressures and has the space to do so.
One final question, if I may take. As far as the tone of policy is concerned, it has been quite balanced this time. No action. But as far as the next year's guidance is concerned, this has been quite surprising, as Jayesh was also discussing. 4.9% is the inflation target, while 6.6% is what is anticipated for the growth front. Do you think there are more steps which may be taken by Reserve Bank of India in this calendar year per se? And also, there has been a focus on growth lately. Even in the last policy, the commentary was the same. Do you think in this policy, this was slightly a miss?
Okay. First, I think many of us are forgetting that last time when they made 50%, 50 basis point cut, that was front loading. That what been 25 basis point then and 25 basis point in this round had been done that way. So that way, to expect additional rate cut at this point in time, it was over and above that 50 basis point cut. That is a little far away. Now, going forward, as I would think this way. Actually, whenever I was expecting, in the sense, a chance that possibly Reserve Bank would look at non-monetary policy-related action to support growth. For example, in terms of regulatory changes, in terms of capital that is required to be allocated for specific segments where the credit growth has been lagging behind, or where we want credit growth to pick up much more, some kind of leeway without touching the policy rates. That could have been one exercise which Reserve Bank can think about in the coming months. I would expect that if they are unable to make changes in the repo related action, then possible, and liquidity related action, then the third tool which is available to Reserve Bank is to make changes in the regulatory policy. Today, there has been no regulatory policy related announcement. Possibly, I would expect the Reserve Bank should be working more on that front also in the coming months. And on the internal, in the liquidity framework, one point we should appreciate that getting volatile because of the digital payments and 24/7 operations. That would mean that certain suggestions or recommendations we should expect in terms of managing intraday liquidity. Elsewhere in other mature market, we have seen that interest rates are even paid and received in terms of hourly rate instead of daily rate. Something similar could be think about maybe. That's one of the areas that can be worked on.
All right, thank you so much, ladies and gentlemen, all the panel members for joining at this hour and sharing your views.